Markets around the world finally started to rally again, and the right stocks were making moves. But is there something more sinister about to occur for August and September? And what do we need to be doing in our portfolios and trade accounts moving into these events? We'll also be talking about China and, of course, Nvidia, the hottest anticipation of an earnings event this season, and it just got an upgrade. Dark pool transactions also occurring underneath the hood over the last 24 hours, which we'll be talking about. With the S&P 500 hitting the first big demand, the US 10-year still breaking out to new highs, and of course Nvidia on a roll, what happens next in markets around the world? We'll be discussing stocks, commodities, and cryptos coming up. Well, welcome back everybody to the Daily Show, where we discuss markets around the world, including the macro lead indicators and the hottest charts. We've got some big transactions coming up today and of course some options discussion that needs to be had. But first up, I want to discuss gamma stocks because of course we saw Nvidia off the upgrade and Tesla doing incredibly well over the last 24 hours. We also saw the rest of the market not really doing very much. So it was a tale of possibly a dead cat bounce or a sucker's rally, and we'll talk about that later on in this market condition of whether this is something we need to be a little bit more concerned about in terms of it truly being the bottom for the S&P 500 and other markets around the world. Let's talk about China and macro for a second though, because of course everybody is now comparing China to Japan of the 1990s, and this is a fair comparison. A lot of people have talked about it in the past. Here are some charts that I pulled out over some reports, such as Morgan Stanley's over the weekend. You can see here that 559% of the GDP was the comparison of Japan's land value, and there's some serious stats going back over that point. In comparison, China is not so bad right now, and they're trying to move away from being so dependent on property, and this is partly why we're holding off, or at least we're seeing a hold off of stimulus across the board at this stage. Share of household assets, you can see, is 40% in comparison to 60%, and you can really see the damage that was done after Japan exploded. Went down to 23%, and at the moment the US is about 28%. So is China high? Yes, it is. It's a little bit higher than you would hope, and I think they're trying to get that back down to around where the US is. 30% would be a good amount. But here's where they have made some improvements, and actually the China economy is slowing, but at the same time it's a tale of two markets. EVs, solar, anything to do with the green revolution and infrastructure, that's going up massively. But at the same time, it's not quite plugging the hole that's being lost in the property sector. And you can see here that that was a huge part of the economic expansion over the last decade. But where are we now? 24%, back down to where we were in 2008, 2009. So have they done a pretty good job of knocking out some of the GDP while still maintaining an economy that's not quite crashed? I would say yes, they're doing it, and we'll see whether they can pull it off. Of course, this is a huge part of why stimulus has not come in, and it's all been segmented stimulus. It's things targeted towards trying to build this new green revolution that Xi wants. Let's now take a look at the US, and we're seeing charts like this everywhere, which is of course increased delinquencies. This is credit card delinquencies 30-day composite. And when you look at this chart, you're going to be like, wow, that's really scary. That looks absolutely terrifying. Well, that is true. It does look terrifying until you look at the long-term averages of credit card delinquencies. So has it been increasing recently? Yes. Are there problems here? Absolutely. Is credit card increasing on pretty much the right scale? Actually, yes. If I showed you a chart, it's coming back into line with the long-term average growth. So really, we're looking not so much, I think, at credit cards right now. What we're actually looking at is probably the auto market, that is used cars and things like this. And specifically, you'll also be targeting in basically what we call zombie businesses. We've talked about it a lot here on the channel, and we'll bring it up in one of our daily shows very soon where we discuss zombie businesses a little bit more, because that's where I think the biggest problem and the potential black swan for the US could be if starts to just crack, and of course there's issues there. Let's now talk about indicators that are hitting the market. We discussed this one in our weekend video, which is the McClellan oscillator, and basically when it goes negative 100, which you can put on your charts in TradingView, you often see a bounce over the next 30 days. Now that's not to say that we've seen the low of the markets, it's just to say that we've seen a point which is now historically 80% of the time bullish over the next 30 days. That's a pretty good stat, better than probably most people's trade records, but at the same time, we have to be careful. We have to obviously be focused on this market. And what I noticed is every single report I read over the weekend, most of them were completely confused. And in fact, it seems like at the moment, price action, as I mentioned in our Monday stream, which we do every Monday live, is basically the most important thing right now. The macro situation could be either soft landing or something more sinister. And that's the issue we've got. It's very difficult to read in between the lines. On a lot of cases, you'd say bears across the board, everyone should sell, everything looks terrible. But then on the same case, you could say, well, central banks continuously plug the holes, which we'll talk about in a second. So the bullish percent index continues to come down. We're sitting at about 54 at this point. And basically at this area here, we know that we could see a turn, but we are still possibly looking for a capitulation sell-off and what we call a bit more fear coming into the markets. That usually marks a nice low. This could be why we're seeing those reasons. UK gilt implosion. Every time the US 10-year, 20-year, and 30-year get near these highs, something breaks in the system. First it was UK gilt implosion, then it was Silicon Valley Bank. At the moment we've got WeWork and all these sorts of things. But there's probably something just going to happen over the next 30 days around the corner, and that could cause a black swan event, something that causes capitulation. Now, of course, we don't know exactly what it is yet. We've had guesses in the comments down below, so let's see if anybody can guess what it's going to be. But it's something that tends to happen when this US 10-year sneaks up to this level, and that's been pretty good indicator over the last 2 years. What about volatility? Do we expect these types of corrections? We just saw about a 6%. Well, yes, the answer is we usually do see these types of things. And in fact, it's less common to see something like a 15% or a 20% plus correction. They're actually quite rare in markets. Could we go lower? We'll talk about that as we bring up the charts later on today. Let's talk about the bear case scenarios. So the bear case scenarios are, of course, we're in a seasonal period for increased volatility. This is pre-election years, but if you take non-pre-election years, basically volatility tends to spike all the way into October, and we have uncertain times. If you have a look here, we could still be having, even though we're going sideways up at the moment, a new dip that happens into September, or even this week when we sell off and we go underneath certain S&P 500 levels that expose what we would call 4200, 4150, which is of course one of our strong case scenarios. We've hit our first one. We'd like to hit the second one to get a nice healthy rally or healthy pullback in these markets, at least for now. What happens next? Well, historically, markets have actually bulled into the end of the year in these statistics. When you have 10% plus first 6 months, you tend to lay over two pretty strong figures, October, November, and December. In fact, I think it's been 100% of the time with 12 positives. And that's not to say that it always works. I mean, it always has in the past, but these are just stats, just things that we want to bring to your attention. Now, with HSBC's upgrade of NVIDIA, what happened in the transactions? A big dark pool transaction just near the end of the day. Could this be a seller coming in to say, oh, thank you very much for the upgrade, guys. We're going to sell the rumor and buy the fact. So that is basically look for a dip after these results come out. I would say this is possibly the most important information. It's the stock that started it all. NVIDIA started the AI kind of bull run this year, and it is also the stock that could really put semiconductors under pressure. If we see this stock move, remember it's plus minus 11% expectation in the options market. This is going to be huge. I mean, we're talking billions and billions and billions of dollars of rotation. Whatever happens here is going to move market sentiment grossly. And if it doesn't meet expectations of forward expectations and everything like that, then we could have issues. Is that dark pool transaction a buy or a sell? I would guess it's a sell, but at the same time, that's a guess. We don't have the overall information yet. And as we always say on this channel, it's better to have patience and react and not predict. If you're bullish on NVIDIA, that's fine. I think it's great stock as well. Price-wise, I think it's expensive. But of course, this is where we're starting to see people coming out with expectations of $700 plus per target. And people are getting a little bit carried away potentially with how good the stock really is going to be. We'll find out this Wednesday. So remember, it's just around the corner. Let's also talk about unusual options activity. And we'll go first in here with J&J. Obviously, the spin-off causing some really big options trades recently on this one, 12.32. Then we also saw some unusual activity through things like Netflix, or not Netflix, SE, and some of the hyper stocks, PayPal as well. And in general, it was a fairly slow day on the options market. If we scroll down, we only had 36 compared to 39.8 and 54% calls. So relatively light volume, relatively light options trading, and that could show a false rally at this point, something I think is important. The market was kind of allowed to get maybe a bit carried away. So have we hit a temporary bottom? Well, by the 20 moving average, that is percent of stocks underneath the 20 moving average, we're back down to where we expect to be. But by 50, which usually gives us a nice swing turn, we're not quite there yet. We'd like to see this get into the 25s to 30s, and it's not there yet. So that shows us that what we haven't had is capitulation sell-off, a large sell followed by a bit of fear in the markets hitting some critical levels. US 10-year still teeters at the high, and I think we need to be paying a lot of attention to this. US 20-year, US 30-year, have them all in your charts, have new alerts set for when we break these highs, and you can see it's tested them perfectly over the last 24 hours. We're basically testing all these highs, and I think US 30-year is actually breaking out in terms of it's just above those previous highs, you can see here. So this marks, if rallies continue and these yields go up, that could be a problem because of course markets will maybe not be so happy about that. Another one to watch is going to be US 2-year versus 10-year. That's turned around a lot as the 10-year plays catch up. And what this means is that we're moving faster and faster and faster towards uninversion. That is where we go below the 1%. When that occurs, that's actually when we will be looking for the idea of a recession. You might say, well, everyone talks about recession all the time. Yeah, but we know historically recessions come when uninversion occurs. So remember, it's unlikely to happen before that point. Watch it over the next 6 to 12 months. You might be surprised. JP10Y, what have we got going on here? New breakout, something we're looking at. Again, showing that the market's maybe not as good as we all think it is. Copper did make a recovery. It's just kind of leaving what was a pretty brutal sell-off. And I still think copper could be moving lower unless we see stimulus from China. Dollar index really stuck in a range here, guys. There's no breakout to the upside or downside yet, and I think we just have to update this once we have the ability to predict. If you're going to trade this one at the moment, you're kind of selling around that 103.40-ish, and you're trying to buy somewhere around this level down here, which is basically 103 flat. That's the change range, and a good way of kind of figuring it out is usually going 1-1 and then looking for a 2-2. And once you see that, you're basically saying, okay, we're in a range until proven otherwise. Is it accumulation or distribution? We don't know yet. I would guess it's distribution based on the run of DXY so far. That is, the US dollar has been very strong. Maybe it's time for it to weaken. We don't know it yet. What about gold? Well, gold actually broke below, of course, one of our key levels. It came down here to that previous week and it found some buyers. I still think gold is probably in a rally into short now because of what we've seen. And if yields keep spiking up, that is 10-year, 20-year, 30-year, don't bet on gold having a great time. There is an unfair gap in here. So effectively, we could move quite a lot lower. 1850 is a real target here for gold. And just be careful on this one. Yields, stagflation, these are discussion points that we've all got. If it's stagflation, gold might do well. But if it continues to be yield problems with the 10-year and the 20-year and the 30-year, I can't be bullish on gold until we see that slow down. US oil also sold off a key level up here, which is of course that previous kind of supply. Markets sold, markets bought, and then they've sold off that level. Until we're underneath 78.60, we don't know we're in a swing trade short. So at this stage, if you look at it on a weekly, you can see it looks kind of bad. It obviously closed below, or it's getting below that long leg doji. But at this point, we just know this was a resistance. We don't know whether it's building a position. And do remember things like the 50 exponential and the 20 that's catching at this red line, they can act as dynamic support. So for oil bulls, they're going to be looking very closely over the next 24 hours at this level here. And for bears, you're looking at breaks below that into, of course, potentially further selling. Let's move over to individual stocks before we do indices. And we've got things like island reversals here in quite a few stocks. So Tesla, we talked a lot about the idea of 210, 200, and we got as low as 212.32. Then we saw an island reversal. We mentioned this in the live stream. We basically said, look, this thing's an island reversal. It looks like it's going to go over the next 24 hours, and it did. And it wasn't just this stock. Many of these stocks did this. So it's an island reversal because it gapped down and gapped up, and it had an absolute big move. I mean, it was a big move. Now, if we take something like a fib over the top of this whole move, and we said, oh, well, what if we retrace back to a 61.8? That's going to be a very aggressive buyout. But if we take it from somewhere like this, the last kind of swings, you'll notice it's going to push us, and even this one here, it's going to push us more into here. So what I'm thinking at this stage is there is a possibility that Tesla and other stocks kind of regain a little bit more of what they've left off because they sold so aggressively. I mean, Tesla moved down well over 20%. So if we have here a cross of moving averages, that actually acts as also a dynamic resistance, and that's coming into a bit of a key critical point, which was the previous support that was then broken